Welcome back to the Green Arc Properties at Keller Williams Greenville Central podcast. My name is Jordan Surrett, and this is our client coordinator, admin, marketing person,
Hanson. So I know we've talked briefly about some stuff going on this week. Tell me what's happening in the real estate world this week.
So this week is huge for not just the real estate market, but the general economy and kind of everything going into it.
Yeah.
So start off with a nice little throat clear there. But this is a great week to be recording the podcast, but unfortunately it's not going to be out in time for all of these things to come to fruition. But we're looking at a huge week. So today is Monday, the 12th, February 12th, I think, or 11th. Something like that. Anyway, so tomorrow is the CPI release, which is the Consumer Price Index, which is kind of the tally of all the goods and services domestically in the U.S. And so that is kind of the measure of inflation. So of course, to piggyback on that, and this is actually the first one of the year, essentially, because it always measures past.
How often do they do the...
So they release CPI monthly, and then the big thing about this one is this kind of sets the pace for the rest of the year.
Gotcha.
So tomorrow's results will show January's numbers, and so March's numbers will show February, and so on and so on. So what we're kind of looking at is they're going to have the month-over-month CPI, which will show month-to-month, not as big of a deal as long as we're trending down. And then they're going to have core CPI, but the big thing that I look for is year over year. So we want to make sure that inflation is coming down and just kind of all of that. So with that, what I was about to say is that we're going to have a ton of Fed speakers this week as well. So everybody on the board and everything of the Federal Reserve is pretty much talking this week, which is kind of crazy. Like you always get one or two speakers, but this week, like if you look at the schedule, there's like they're all talking. So I think we should anticipate hopefully some good numbers to kind of show. And then yesterday, officially or unofficially, kicked off the real estate season, kind of the time of the year when everybody starts
planning,
coming out of hibernation from the holidays and everything, and kind of starting to think about selling, think about buying, think about moving in general. So it's gonna be kind of a crazy week.
So what starts off tomorrow? I know you said the Fed, but then
so CPI is tomorrow. And that'll kind of give us an idea. And so the CPI, like I said, is all goods and services domestically that have been bought and sold. So that gives us an idea of how much prices are fluctuating, especially with the month over month and the year over year.
But not housing market directly. It's just kind of...
I'm really glad that you said that. So yes. So actually the housing market plays about a third of the CPI.
Okay. So
it's a huge number as far as CPI goes. So if housing prices are going up astronomically, like they were in 2020, 2021, 2022, then we're going to see a huge impact to CPI and also to inflation. So as kind of the past few months, we've seen a little bit of kind of a calming period. And our area has seen less of a calming period than like the rest of the nation, because we have so many people coming from all over the country to the upstate of South Carolina. But what we're really seeing is a little bit of a slowdown. And we have been seeing that for the past couple of months. Well, what's interesting is the last maybe 2 weeks, we've seen it kind of start to pick back up. Buyers are kind of starting to come out. Houses are getting more showings. They're getting more overlapping showings. 5 o'clock, 6 o'clock. You have three people there looking. Open houses are starting to see a little bit more uptick as far as people showing up to those. So I think we are kind of getting into that season. But I also think there's a lot of other stuff at play.
Yeah. So I know that kind of happens tomorrow, and then I think Thursday you said something was happening with the
Yeah, so all week. So we have Fed speakers every day. So we've got, I think, at least one Fed speaker today, if not two. We've got several tomorrow. We've got one on Wednesday. We've got several on Thursday, with good reason, and then also on Friday. Tomorrow is CPI, and then Thursday is going to be retail sales, which is basically how the economy is doing, how much retail is actually performing. And then we're also going to get unemployment numbers on Thursday, and kind of give a clear idea of what's going on in that. So unemployment will, of course, kind of play into the general feel of the market as well. Mm-hmm. Because if unemployment's going up substantially, then typically what we're going to see is inflation coming down a little bit because there's not as many buyers, right? Everything is supply and demand as far as market goes. Mm-hmm. So when we have retail sales and unemployment kind of together on Thursday, then we'll have a clear idea of kind of what's going on. And then we're going to have a ton of Fed speakers. And then Friday, the PPI comes out, which is the producer price index, that's going to kind of give us an idea of how businesses are doing as far as producers.
And they give you like a rate or a percentage? Or
so it'll be a percentage.
Okay.
So basically just with CPI, it's the same thing. So we get kind of an idea of how much it's changed overall, mm-hmm. and then how much it's changed month over month, and then how much it's changed year over year.
And then a higher number would be better or worse? Bad.
Well, it depends on who you talk to. For
the housing market.
For pretty much for the majority of people, we want to see CPI come down.
Yeah. Because that represents how much inflation has improved.
So that's kind of the big telltale of inflation.
Yeah.
So when we see CPI released, we can measure inflation and say, okay, well, inflation's at 6% or inflation's at 3%, mm-hmm. And
kind of like a domino effect for everything.
Right.
Yeah.
100%. So what we want to see, and the Fed has been preaching this, is they want to see 2% inflation.
Okay. Do you know what it is right now?
So I think last time it was 3.2 or 3.4.
Which doesn't really sound like a lot percentage-wise, but at the same time, I guess
yep.
you're thinking overall too. So.
Well, so the big thing, and you have to think about, is percentages matter more with higher prices.
Yeah.
And with the housing market being, a third of the CPI, when you're talking about a $200,000 house or a $300,000 house, 3% increasing is a lot.
Yeah.
I mean, or 6%, which it was at one point, is just overwhelming. Mm-hmm. I mean, like 6% a year, or I think at one point we were over 9%.
Oh my gosh.
During COVID. Yeah. Well, I mean, we had so many buyers, and we still have that.
Yeah.
But inventory is slowly starting to catch up. Inventory being houses for sale that people actually are buying. So right now we still are in a seller's market because we don't have enough inventory. Mm-hmm. Even though we've come up a little bit as far as inventory.
Kind of neutralizing a little, trying to.
Yeah.
Trending that way.
And what you'll hear most people in real estate, mortgage people, realtors, all investors, all of those, they'll talk about a normal market. Whereas you have 6 months of inventory if no other houses came on the market and no other buyers came in. Like if everything remains the same, then in 6 months inventory would be gone. I think we're at like 3 months now. So if no buyers came in and no houses went up for sale, in 3 months we'd be out of houses. And that's
scary to think
crazy.
About. Yeah, scary.
So, but I mean, fortunately people are always changing, situations are changing.
Yeah.
You need, more space, you need less space. I just got off the phone with another agent. They have a buyer client that's potentially thinking about downsizing. Mm-hmm. So one of our properties is a good fit for them.
Yeah.
But there's always changes and personal changes, family changes, business changes. People, they get a promotion and now they can afford a little bit more house, or maybe they want to move closer to work, or, all the things are always changing. So I don't, save something drastic and crazy. Like, houses will keep coming on the market.
Yeah.
What we've started doing, though, is what we found is clients don't know, and I think we talked about this last time maybe, but clients don't know how much money they actually have in their home. And we just met with a lady over the weekend. She's got $173,000 in equity.
You just get in the routine of just paying the payment and not thinking about really where it's going.
Yeah. And her jaw dropped when we told her, if we put this on the market right now at an average price for what the neighborhood is selling for, you would come out after everything about $173,000 in your pocket. Immediate shock. So that's something we're trying to kind of get out there and let people know that if you own a home and
at least check,
and you've bought it more than 2 or 3 years ago, you probably have a sizable amount of equity.
Yeah.
And the big part of that, again, circling back to kind of our primary talking point this time, is inflation.
Yeah.
So inflation has been, going through the roof, for the past 2 or 3 years. And if you've been gaining between 6 and 9% a year on a $300,000 house, that's $75,000 in equity, essentially, or around about,
money that you could take out when inflation is high, while inflation's high, and pay bills or pay debt or
100%.
Catch up or whatever you have to do.
2 weeks ago, we set a past client up. We're just kind of calling around and saying, hey, guess how much equity you have in your house?
Yeah.
And they had been wanting to do some repairs, and they haven't had the money to do it. So we sat down with them, told them how much equity they actually had, and now that might have actually gone through. I don't know. I'll have to check back in. But they're doing what's called a HELOC, which is a home equity line of credit. Basically, they're taking out, I think they were doing between 20 and 30 grand. Not even the full amount that they had, and they had, well over 50 grand. But they were going to pull out 20 to 25 grand. And
it's hard to imagine that just at your fingertips too.
Like
money, just
here.
Yeah.
And if
you're not looking at in an account, but it's still sitting titled to you.
And it's a line of credit. So you only pay interest on what you take out.
Yeah.
But now they get to do all their repairs. It's not really going to cost them that much, over time.
Yeah.
And he's like, well, we were going to save up for 6 months, but now we can do it.
Yeah.
And we don't have to worry about it. And then, we'll just pay it back and whatever. So there's a lot of equity out there that I think people just aren't aware of. So we're trying to get the word out and say, hey.
Even before I started, in the real estate world, I had no idea what a HELOC even was.
Yeah.
So.
And now you hear it every day.
Yeah. So now it's just, knowing that when you buy a house, you are investing into your future. That money is going somewhere that you could potentially leverage it, later
100%.
on. So
100%.
That's awesome.
And and people don't realize, and they're like, we've got to rent for a couple of years and save up. And it's like, well, in a couple of years, you could potentially be gaining 5-6% interest just by owning and paying your mortgage.
And mortgages nowadays are right up there with rent costs,
In a lot of cases, they're cheaper.
Yeah.
Especially, so I had a client first week of January. They bought a home and they got a 4.99% interest rate with a brand new construction house with a builder that spent $20,000-$30,000 to buy their interest rate down. And their payment, so they were renting somewhere, and their payment was actually, I think, $200 or $300 less than what they were paying in rent.
And you don't know, what kind of bedrooms, how many bedrooms they had in either one?
So their rental, I think, was 3 bedrooms.
Comparable to what they're moving into.
And their new house was 4 bedrooms.
And
twice the size.
Hundreds cheaper.
Yeah, a couple hundred. They got a house and a yard.
Yep. And you have something to show for your money.
Yeah. And now, and they're in a newer neighborhood, so they're going to potentially gain equity a lot quicker.
Yep.
Because what most builders do, and here's a little trade secret. So what most builders do is they come in, and so, the first 50 houses in the neighborhood are relatively cheap because they want incentive. New neighborhood, you're going to have to be dealing with a lot of construction, things like that.
They want you to move in.
They want you to move in, and they want to start establishing that. But then every 3 to 5 houses they sell, they have a price increase. And they use the previous 3 to 5 sales as comps. So they're comping their own neighborhood to raise prices.
Yeah.
Which is fine because as long as you have buyers, that's good for everybody. Everybody's gaining equity. The first 100 people in the neighborhood are gaining equity a lot faster.
Yeah.
Because now, if you have another 200 or 300 houses that you're building in there, every 3 to 5 houses is another price increase.
Yeah.
So you buy yours for 200, and then 50 houses later, you've had 10 price increases. Now that might only be $3,000-$4,000 each time, but over 10, that's 30, 40 grand that you've made in a year or two,
and not doing anything. Sitting in the house,
paying your mortgage. That's it.
Yeah, and you're gonna have to pay regardless of where you are.
Right.
So at least
if you're renting, you're paying somebody else's mortgage.
Yep.
I digress though.
And a lot of these neighborhoods are building 300, 400, 500 homes in the in the neighborhood. So
there's
definitely
a lot.
building up fast.
That's real guy. You're good. So we can talk about this too. So also Friday is going to come out the housing starts, which is basically and also building permits, which gives us an idea. Another mid throat clear. Yeah. So that'll give us a clear idea of what builders are actually doing.
So what actually comes out with that though? Like what information?
So basically, so it'll give you an idea. So the big thing is, so last month, how many houses were started? How many
like brand new homes?
Right. Exactly.
Gotcha.
Exactly. So and I haven't looked at actually this data in a while. I need to glance at it today. But one of the big things is we were like 15 million houses behind a couple years ago. Like
the upstate or the country?
That was national.
Okay.
So we had to literally not buy or sell any houses for like 10 years to catch up with the amount of inventory that we had based on the buyers coming in and the sellers coming in. So it was kind of, inverse relationship. So that'll give us a clear idea of what builders are doing. Have they increased production? Have they decreased production? Are they showing us because they always have some kind of insight.
Yeah.
They're kind of looking at the market.
Yeah.
They're in it to make money, right?
Yeah.
So they have research teams, where they're going to build, how they're going to build, floor plans that make the most sense, the cost of production, all of that. So if they increase their amount of builds, that's usually a really good sign for the real estate market. So if they're coming in and they're saying, okay, and this is completely made up numbers, but say last month we built 100 houses, but this month we're building 125. So now we're increasing production. So we know something.
Yeah.
So that'll be some really good numbers to look at on Friday as well, just to kind of give an idea. Also on Friday is, and I might have said this, I might not, but consumer sentiment.
I don't think you did yet.
So that's basically how the overall consumer, and they do surveys and all that with general population to see how people are feeling about the economy. So that'll give us a good idea. I'm telling you, this is a crazy week for not just real estate, but the entire economy and just kind of like everything with that.
So our next podcast, we're going to touch base on.
Yes, we're going to circle
updates.
back and see what happened the week of February. I don't know. I'm going to call it the week of February 14th, the week of Valentine's Day, because that's this week. But we just really want to watch all of that and kind of know what's going on in the market. And I don't think real estate people, whether it's mortgage people or investors or realtors even or anybody, really talk about that enough.
Yeah.
Because we just. I don't know. It's important.
Yeah.
It's very important.
Definitely has an impact.
Yeah.
Yeah.
And, if you don't know what's going on, then, when
you don't know what choices to make.
Exactly.
Yeah.
So, mortgage rates start skyrocketing and you're like, I don't know what's happening.
Yeah.
It's like
definitely important to be involved.
Yeah, right. And then they start dropping and they're like, oh my gosh, are they going to keep dropping?
Yeah.
Well, I don't know. It depends. Like let's look at the mortgage-backed securities. Let's look at the bonds and see. Because that's really, and we'll get off on a quick tangent here, but when the Chairman Powell comes out and says, we're holding rates steady, or we're increasing rates, or we're decreasing rates, or whatever, people think that has a direct impact on mortgage rates. And it really doesn't. Basically, that's the rate that the Fed charges banks for money. So ultimately, it doesn't impact mortgage rates directly, but it impacts investors and consumers, which kind of determine what mortgage-backed securities are going to do. And I know I'm kind of getting a little bit technical with that, but that determines what mortgage-backed securities are going to do, what the bonds are going to do, and that determines what rates are going to do. So, and this is the best example, because this is the example that everybody understands, is during COVID, like the entire economy just like crashed, like it just, down. And so what happens to mortgage rates?
They went down. They
went way down, like under 3.
Yeah.
So, but basically
trying to incentivize like.
So not really. So it's all based on the consumer and investors. So investors started running, what's the saying, tuck tail and run or something, I don't know. And so they started running to more secure investments, which is the bond market. So they start buying up bonds, ridiculous. And so, mortgage-backed securities start going down, then the mortgage rates go up. So they start buying all these bonds, mortgage-backed securities start going up, mortgage rates go down. So they kind of flock to kind of the security, which is a play on words, but the mortgage-backed securities, the security choice of their investment, because nobody knew where really the economy was going.
Yeah.
So everybody starts flocking to mortgage-backed securities. Mortgage rates or mortgage-backed securities go through the roof, so mortgage rates go down. They plummet because now the bonds are going up. Banks are making money, so they don't have to charge as much. So that's kind of how that is. Look that up. That's a very good read to kind of understand how all that plays out and whatnot. And I think the average consumer honestly should understand it, because if you do, then you can say, oh, look, jobs are super strong and, the economy's coming back, but why are my mortgage rates still going up? And it's like, well, that's why. Because bonds are dropping because everybody's running to the stock markets and ETFs, exchange traded funds, to get a better investment, the better return on their money.
Yeah.
So they're leaving the bonds behind. Bonds are dropping, so the banks aren't making money on the bonds as much, so they raise the interest rate. So that's why it's so important to watch the CPI and the PPI and listen to the Fed chairs and all the little Fed people.
Because whether you know it or not, it's impacting all of us.
Absolutely.
Yeah.
It's impacting everything. And just knowing the numbers is kind of the big tell of it.
Yeah, so, knowledge is power.
Knowledge is power every single
time. So next time I know we'll have a guest.
We will.
Who can
you get a day off from podcasting.
One day. But he'll be able to kind of like talk to us a little bit more about rates and that kind of stuff.
100%, which is going to be very useful, because now we can talk about what happened this week, but it'll have already happened. So we can talk about the impact that it has and the numbers that came out versus the projections and forecasts and all of that.
And what our guy thinks
and what an actual banker
thinks is going to happen.
It's going to happen. Yeah. So I'm sure that'll make him uncomfortable, because every time I mention mortgage rates and what's going to happen, you always get the head scratching. Just because they don't want to say, because general public and realtors and everybody else tends to hold you at what you say.
Yeah.
So if you say, well, I think mortgage rates are going to go down to 5.5%, then 6 months from now, if they're at 5.6, it's like, well, you told me 5.5. And
well, it's just a forecast.
Right, exactly.
That's what we think is going to happen.
Exactly.
So.
But you never know for sure because anything can happen. But we'll definitely have a good conversation with him about what might happen and what definitely has happened this week.
And what hopefully happens.
And what
throughout the rest of the year. Yeah.
So, quick word, we'll kind of wrap it up. But if you or any of your friends, family is even thinking about maybe real estate in the upstate of South Carolina, feel free to reach out. We'll have our contact information somewhere on the screen here. So feel free to reach out, and we'd love to talk to you. If you want just kind of an idea of how much your home might be worth, we'd be happy to talk to you. No strings attached. Come sit down with you, take 15, maybe 20 minutes, and just give you an idea of how much equity you actually have in your home. And
even all the other things too, right? Like
If you want some ideas on if you're thinking about it, but you're like, well, maybe if we redo the floors, then we can get a little bit more.
We have a floor guy.
We do have a floor guy, but we've got all the guys and girls. If you need them, if you need it done, we probably have somebody that can do it. But the thing that I advise clients is never convert dollar for dollar. And what I mean by that, if it's going to cost you $100 to install new floors, but you're only going to get $100 back on it, unless you're getting a huge amount of marketability for that, then it's not worth it.
Yeah.
So if your floors are just like grimy and they just need to be redone and it adds kind of a better look, okay, fine. That's fine if it's dollar for dollar. But because you always want to make a little bit.
Yeah.
So if you invest $100, we want to see about $110 return minimum, maybe more.
Yeah.
Because if you're going to be doing all the labor and having to deal with all the construction and people coming in and not having floors for a day or two,
you got to ask if it's really worth it.
We want to make sure that it's worth it and that it makes sense and it's a good strategy. And it doesn't matter where you are. If you're not in the upstate of South Carolina, we have a vast network of people that we have
referrals out to.
Yeah, so we can definitely hook you up with somebody that can take care of you and make sure that you are in good hands. So, closing statements, anything?
I think we're good until next time.
Perfect. We'll see you guys next time. Thanks so much for watching. And we look forward to having a mortgage banker next time. So look forward to that. And we'll see you guys soon.
Bye.